Hi, welcome back to Grace and Finance. Today we will be discussing the truth about capital gains. The truth is that capital gains are not always what they seem to be. Capital gains tax is a tax on the profit you make when you sell an asset for more than you paid for it. One of the simplest ways to profit from investing is to buy an asset at a low price and then sell it at a higher price. This type of profit is known as capital gains. Many people confuse their capital gains taxes with their earned income taxes. However, they are not. The tax rate on capital gains is typically lower than the tax rate on earned income. The reason for this is that the government believes that people have a greater incentive to sell assets if they know they will pay less in taxes by doing so. Like other forms of profit, they're subject to taxes. Taxes can impact the growth of your portfolio, and we're going to explore how capital gains taxes work and what you can do to minimize them. Taxes can be complex and vary based on a lot of factors, so it's always best to consult the IRS or a tax professional to understand your specific situation. Let's start off with a really easy example. If you're an average investor, this is generally what should be done to maximize your investments. You buy a share of stock XZ for $20, and over the course of a year, it increases to $30. At this point, you've gained $10, but it's an unrealized gain, because it is not considered profit until your position is closed. Regardless of the duration you hold your stocks for, or the price change it goes through, you will not be taxed on gains as long as you don't close that position. Note that dividends from stocks may still be subject to taxes. Now, back to our example. Let's say you decide to sell the stock at $30. That is considered a realized capital gain, which makes it a taxable event. You now owe taxes on the $10 profit. Let's focus on stocks in this video, but be aware that capital gains taxes also apply to other investments like real estate, bonds, and mutual funds. So, how much are our capital gains taxed? There are two types of capital gains, short-term and long-term. It mainly depends on two factors: how long you held the investment and your income level. Typically, when you sell an investment from which you earned a profit within a year of purchase, the profits are classified as short-term capital gains. Income from this source is typically taxed at a rate equivalent to your ordinary income, determined by the marginal tax bracket you fall into. For reference, marginal tax rates for the 2020 tax year ranged from 10% to 37%, but rates can fluctuate over time, so it's best to check on what income taxes are currently like with the IRS or a tax professional. Long-term capital gains are usually taxed less. They're always seen as bringing positive economic consequences, which is why they may be less taxed. The specific rate may still vary based on your income. But for reference, the 2020 long-term capital gains rate did not exceed 15% for most people. Again, rates can change over time, so it's best to check with the IRS or a tax professional. While most people file a yearly income tax, there may be an interest in saving your profits if you are expected to pay tax on gains. If you had any of these and it's too late to report before the deadline, it might be a good idea to factor this into your preparations. Taxes can have a significant effect on your investment portfolio, so it's important to plan for them and be proactive. First, let's look at the pros and cons of both long-term and short-term investments. Active traders sometimes increase returns by quickly buying and selling investments. However, paying taxes and fees on your investments can be difficult, as it will reduce your net returns. A good alternative is to invest in a diversified portfolio of low-cost index funds that are constantly taxed at lower rates. When choosing an investment strategy, make sure to consider the after-tax effects. Second, consider maximizing tax-advantaged accounts, like retirement and education accounts. Reducing your tax burden could potentially help your portfolio grow faster and help you pay less in taxes. One important thing to do in your taxable account is take advantage of your losses. The IRS give you the ability to take these trading losses and use them to offset some of your capital gains taxes, and this can actually benefit you down the line. For example, tax loss harvesting is a strategy that involves closing certain positions to intentionally realize losses that reduce your tax liability. A lot of brokerages offer automated tax loss harvesting services, but it's not for everyone. Be sure to consult a tax advisor before deciding if you would like to manage your losses yourself through something like TaxAct or TurboTax. It's easy to mix up tax planning and capital gains calculations, and even seasoned investors like to save themselves from the hassle. Do you have any crazy tax stories? Tell us in the comments below. If you found this video informative, please give it a like and subscribe to our channel. Thank you for watching.